Hey everyone, welcome back to Corporate Decoder, the place where we turn financial reports into something you can actually understand. Today we're diving into the IV Variable Insurance Portfolios report, but don't worry, I promise it's more interesting than it sounds. We will look at changes in the portfolio to make it more AI focused and the performance results, so buckle up. First up, this isn't about just one company, but a whole bunch of investment groups or series under one big umbrella. Think of it like a box of assorted chocolates. Each chocolate is a different company inside the fund. They range from asset strategies to balanced approaches, and each has its own focus. This report covers the year, letting us know how these investment options fared from January through the end of December. It's crucial info if you're invested in these because it shows how well your money was managed and what kind of changes they did to the investments. Let's kick things off with the VIP Asset Strategy series, which changed its name from Delaware Ivy VIP Asset Strategy mid-year. Seems like just a branding update. So what did it cost to be in this series? For the standard class, it was about $65 for every $10,000 invested. Not a bad price to pay to have experts do the job of money managing for you. But how did it perform? For the year, it returned almost 13%, which is not bad, but it falls behind the MSCI ACWI index, which returned over 17%. That's the series' broad securities market index, so the VIP Asset Strategy series is lagging behind. But its top equity holdings, such as Microsoft, NVIDIA, and Amazon.com, still did fairly well, as the performance was mainly driven by US technology stocks. When we dig further into this asset strategy series compared to a broad benchmark, the exposure to US equities and information technology and commodities like gold helped propel risk assets forward, but the allocation to fixed income underperformed benchmark. It looks like they made some changes throughout the year. A new tactical investment strategy using mostly derivatives and ETFs was added. Now let's check in on Macquarie VIP Balance Series. This one's trying to find that perfect balance between risk and reward. The cost was $91 for every $10,000 invested, slightly higher than the VIP Asset Strategy Series. It also returned a little higher, at 15.60% over the year. Exposure to US equities propelled risk assets forward, however there was an underperformance in fixed income, which were a drag in overall performance. A balanced approach like this can help cushion the blow when one area of the market isn't doing so great, but it does mean you may not get the full benefit when that area is soaring as well. The same thing happened in the VIP Asset Strategy series here as well. Another tactical strategy with derivatives and ETFs was added. Moving on, we've got the Macquarie VIP Energy series. That's all about exposure to oil and gas, but what's interesting is that this one did not have a great year. It did cost the same at $93 to hold for every $10,000 invested. But instead of gains, it returned a loss of over 5% for the year and underperformed the broad market and its narrow market index. The returns was dragged down by the series' underperformance in renewable energy companies as solar providers came under pressure. Oil service equities also detracted as E&P companies slowed investment during the year. As with the previous funds, this series also had a fee waiver, but what is very interesting is that it made money on fees from holdings that detracted from performance. Ouch. Then there is the Macquarie VIP Growth series, which is all about high potential companies to boost gains. The fees to hold a $10,000 investment cost more or less the same at about $112 per $10,000, but its portfolio composition is almost exclusively common stocks. Which is great because its returns for the year was almost 24% and just a bit shy of the Russell 1000 index. The top drivers were consumer staples, the IT sector, and the lack of Merck and advanced micro devices stock. Again, similarly to the previous funds mentioned, the series market index changed. We also have Macquarie VIP High Income Series, seeking to maximize returns on investments by any means necessary. It cost about $71 for every $10,000 invested, cheaper than other series mentioned. It has a pretty good return on 6.44% for the year, driven by relative equity and security selection effects. The series' broad market index changed similarly as to the rest of the mentioned series. There's more. We also have Macquarie VIP International Core Equity Series, which was the result of a merger. Effective in March, the cost per investment went way down from $0.92 down to $0.88. Despite the cost efficiency, the returns are not the best. They returned a measly 0.92% in December, and the fund added investment strategy by adding a new tactical completion strategy. Also, a few more to dive in. We have Macquarie VIP Mid-Cap Growth Series. This strategy focuses on mid-sized companies that are expected to grow at a good pace. The Macquarie VIP Mid-Cap Growth Series, standard class, returned 2.47%. Unfortunately, that was far short of its benchmark indices, but the series has an overweight to reliable and durable earnings quality. For the remaining series reports, I will keep these bullet point. Next up is Macquarie VIP Natural Resources series. The team continues to add to what's expected to come online. With a cost per investment of 1.21%, the Macquarie VIP Natural Resources series service class returned 5.60% for the year. The top driver this year was natural gas pricing that were starting to trough. Effective May 1, 2024, the series changed its name, adding a tactical sleeve as well as adding ETFs. We also have Macquarie VIP Science and Technology series. For $1.15%, the returns was above 30.59% with its holding of Microsoft, NVIDIA, Taiwan Semiconductors. The performance drivers was largely on artificial intelligence, as they expect exponential growth over the next few years. Lastly, we have Macquarie VIP Small Cap Growth Series at only a 14.26% return. This smaller company has about only $200 million in holdings. The driver was from restaurant equities in its portfolio, and the holdings in that was in that sector. The final series had just its name changed to Macquarie VIP. Now, what's my take? It really all depends on your goals. The energy fund had a rough year, but if you're betting on an energy revolution, then Macquarie VIP Energy series might be a good fit for you. The growth funds really capitalized on the technology sector, while the diversified and high-income series did well enough, but it's tough to beat a booming market, which many of the indexes did. Overall, the Macquarie fund is well managed and diversified, so you don't have to worry as much about an industry going belly up. Thanks for watching. If you enjoyed, please subscribe, like, and comment.